Hey everyone, welcome back to Corporate Decoder. Today we're diving into a company that went public in a big way through a SPAC CID Holdco. And let's just say their latest quarterly report is quite the read, full of interesting financial maneuvers and a serious look at their business health. Before we dive deep, if you're new here and you love getting a real story behind corporate filings without all the jargon, make sure you hit that subscribe button. We break down these complex documents so you don't have to. Also, we have a fantastic community over on Discord discussing these kinds of filings, so check that link in the description below. Alright, let's get right into CID Holdco's Form 10Q filing for the period ending June 30, 2025. This report offers a snapshot of their financial situation a few months after a major business combination, which is essentially them going public through a special purpose acquisition company or SPAC. Think of it as a rebirth and a merger all rolled into one. So first up, let's look at the balance sheet. This is like a snapshot of what the company owns and what it owes at a specific point in time. On June 30, 2025, CID Holdco had total assets of about $10.7 million. That's up significantly from about $3.1 million. At the end of 2024, the biggest jump we see here is in cash. It shot up from a little over $700,000 to a cool $6.4 million. That big increase in cash is a direct result of that business combination we talked about, bringing in fresh money. Now, let's look at the other side of the balance sheet. Liabilities, their total liabilities went down from a whopping $27.3 million at the end of 2024 to about $9 million in June 2025. The number is zero. This is a huge development. Safe notes or simple agreements for future equity are a way for early stage companies to raise money. They convert into stock later, usually during a funding round or when the company goes public. So seeing them disappear from the balance sheet means they were converted into stock as part of that business combination. Or trader dive URDs, they had over $25 million in something called safe notes. At the end of 2025, that number is zero. This is a huge development. Safe notes or simple agreements for future equity are a way for early stage companies to raise money. They convert into stock later, usually during a funding round or when the company goes public. So seeing them disappear from the balance sheet means they were converted into stock as part of that business. Despite this reduction in liabilities, the company still has a substantial accumulated deficit of almost $55 million. That means they've lost more money than they've made since they started. But their total shareholders' equity actually went from a negative number, a deficit of $24.2 million, to a positive $1.7 million in June 2025. This is a direct result of that business combination and the conversion of those safe notes into equity. It looks like they're turning their financial picture around, at least on paper, by bringing in new capital and converting debt to ownership. Now for the income statement, which shows how much money the company made and spent over a period. For the 3 months ending June 30, 2025, CID Holdco reported revenue of about $126,000. That's a massive jump from just $23,000 in the same period last year. For the first 6 months of 2025, revenue was around $479,000, a big increase from about $101,000 in the first half of 2024. This revenue is mainly from feasibility study reports they provide to businesses. Count in 2025, revenue was around $479,000. A big increase from about $79,000. A big increase from about 104025. Revenue was around $479,000, a big increase from about $1,424. This revenue is mainly from feasibility study reports they provide to businesses. But here's the kicker. Despite this revenue growth, the company is still losing a lot of money. For the 3 months ending June 30, 2025, they reported a net loss of nearly $29 million. For the first 6 months, that loss ballooned to over $30 million. That's a huge number for a company with revenues in the hundreds of thousands. How do they lose so much money? Well, look at their operating expenses. General and administrative expenses alone were over $800,000 for the 3 months, and sales and marketing were nearly $770,000. Research and development was another $81,000. These are substantial costs, especially when compared to their revenue. Then there are these other expenses which are really significant. The change in fair value of safe notes comes in at a massive negative $17.9 million for the 3 months and a negative $17.3 million for the 6 months. This reflects how the value of those convertible notes changed, and it significantly increased their reported losses. On top of that, they had transaction costs of almost $2.7 million, and a loss from extinguishing debt of over increased their reported losses. On top of that, they had transaction costs of almost $2.7 million, and a loss from extinguishing debt of over $5.7 million. Both directly tied to that business combination event. All these factors combined explain that huge net loss. Looking at the statement of shareholders' equity, we can see the impact of the business combination and the safe note conversions really come to life. In the 3 months ending June 30, 2025, they had a net loss of almost $29 million, which reduced their shareholders' equity. But remember that reverse recapitalization we mentioned, it completely reshaped their equity structure. Suddenly they issued a lot more shares, and the additional paid-in capital, which is basically what shareholders paid above the stock's par value, shot up to over $56 million. This event, while making their equity look positive on paper, is more about how the existing company transformed into a public entity by issuing lots of new stock. Let's check out the cash flow statement. For the first 6 months of 2025, CID Holdco used about $3.7 million in operating activities. This is driven by that large net loss we saw, even after adjusting for non-cash items. They also used about $743,000 in investing activities, mainly for property and equipment and capitalized software development. The big story here is actually in financing activities. They brought in over $10 million from financing, primarily from those PIPE investors. That's private investment in public equity. They also received proceeds from their trust account, which is common in SPAC deals, and had some bridge loans. This influx of cash is what's keeping the company afloat. The net effect is a significant increase in cash on hand, up from $721,000 to over $6.4 million. It's clear they are heavily reliant on external financing to keep the wheels turning. Now, let's dig into some of the notes. The company has a history of operating losses and is still in the early stages of developing its technology. They're essentially trying to make a name for themselves in industrial IoT and asset tracking. They even have a manufacturing facility in Puerto Rico and development teams in India. The big event, as we've seen reflected throughout the financials, was the business combination that closed on June 18th, 2025. This is when they officially became a public company, merging with a SPAC called Shoulder Technology Acquisition Corp. This transformed their legal structure and brought in new capital. The company is adopting all new accounting standards, which is standard practice, but what's really interesting here is how they account for that business combination. They're treating it as a reverse recapitalization. This simply means that for accounting purposes, the older company, CID, is considered the acquirer, and the SPAC, Shoulder Up, is the company being acquired. This approach means that all the financial history of CID carries forward and no goodwill or intangible assets are created from the deal itself. It's a complex way of saying the existing business structure and its losses are essentially preserved, but now operating under a new public company entity. Hold on a second, this is a big one. CID Holdco had to restate their prior period financial statements, specifically for the 6 months ending June 30th, 2024. They realized they hadn't properly reflected the fair value of those safe notes was calculated. This kind of restatement often points to issues with internal controls and accounting processes, especially in newly public companies. They are also restating cost of goods sold for an operating expenses, which had no impact on the overall net loss, but shows them refining their cost categorization. Here's something important. CID Holdco has only one single reportable segment. This means all their revenue and all their expenses are tied to one business activity, providing feasibility study reports to businesses looking to improve their operations with tracking technology. This lack of diversification could be a risk if this one segment doesn't perform well. And now for a section that many companies dread but is crucial for investors: controls and procedures. CID Holdco admits their disclosure controls and procedures were not effective as of June 30, 2020, 2020, 2020, 2020, 2020, 2020, 2020, 2020, 2025. They've identified material weaknesses in their internal controls. They specifically mention issues with first, costs of goods sold, where expenses were improperly categorized, leading to a significant misstatement. This was due to a lack of preventive controls on purchase orders and detective controls for analyzing expenses against production. Second, they lack adequate accounting personnel and haven't implemented proper processes and internal controls for timely financial reporting. This includes issues with journal entries and segregation of duties, which basically means not enough checks and balances. And third, there's a weakness in controls related to the fair value calculation of safe notes. They admit their controls weren't precise enough and could lead to material errors in valuation. They are actively working to fix these issues, including hiring more accounting staff. This is a common challenge for companies going public, but it's a red flag for investors. So now, let's bring it all together. CID Holdco is a company in the early stages of growth, trying to carve out a niche in the asset tracking and IoT space. Their recent business combination and SPAC merger dramatically changed their financial picture, bringing in cash and converting debt to equity. This is a classic SPAC story where the public market provides the capital for aggressive growth plans. However, the numbers tell a story of a company still burning through a lot of cash. Despite revenue growth, the net losses are enormous, largely driven by massive operating expenses and the significant costs associated with the business combination itself, including the accounting treatment of those safe notes. The restatement of prior period financials and the admission of material weaknesses in internal controls are also concerning. It suggests that their financial reporting and oversight systems are still catching up to the demands of being a public company. The fact that they have only one business segment feasibility studies means their success is heavily dependent on the performance of this single offering. While they intend to expand into SaaS subscriptions and IoT devices, that's a future prospect. The immediate reality is a company that needs significant ongoing capital to operate. The equity line of credit for up to $50 million is designed to provide that runway. But it also means potential future dilution for existing shareholders if they need to sell a lot of stock. In terms of direction, the company is clearly pivoting hard towards sales and marketing to drive customer adoption, which is a necessary step for growth. But the high cost of customer acquisition, as reflected in their sales and marketing expenses, needs to translate into profitable customer relationships quickly. Ultimately, CID Holdco is a high risk, high reward situation. The technology they're developing has potential, but they're facing immense challenges in scaling their operations, managing their finances responsibly, and achieving profitability. The current financial state shows they are heavily reliant on external funding and are still working to build a solid foundation for financial reporting. Investors would need to be comfortable with the substantial risks involved, particularly the large operational losses and the ongoing need for capital. What do you think about CID Holdco's aggressive growth strategy and their financial health? Let me know your thoughts in the comments below. If you found this deep dive valuable, give this video a like and subscribe for more. And don't forget to join our Discord community for more discussions like this. We'll see you in the next one.